So good afternoon to you. This is still your tutor, Henry Berman. And as you know, we are in to debrief the topic financing decisions. We are in for debriefing. Still, students can WhatsApp or call me by 0243-583352. Or students can email me by bermanhenry1@gmail.com. bermanhenry1@gmail.com. For questions, any suggestions, please, you can do that through WhatsApp 0243-583352 or by email bermanhenry1@gmail.com. Financing decisions. We have indicated that the financial manager can take a lot of decisions, but paramount among them happens to decisions which are financing, decisions which are investing, decisions which are working capital. We tend to take these decisions, right? Good. When we talk about financing decisions, we are looking at making a decision as to where to obtain our funds from. Here we are looking for providers of finance. So where are we going to get funds from? You can have funds from a lot or get funds from a lot of sources. But we are saying that irrespective of whatever funds you may get, we can categorize them under two main headings. It's either going to be equity source or it's going to be a debt source. Now, we all the time see in financial reporting and financial management that preference shares turns out to act just like debt. But we need to be very careful with that statement. We have types of preference shares. We have redeemable preference shares and irredeemable preference shares. So we have irredeemable preference shares. Then we have what? Preference shares. Let me just reduce the size a little bit to 10. Then we have redeemable preference shares. Now, with redeemable preference shares, this is, preference shareholders are given equity, they act just like creditors. What happens is that when these shares are redeemable, please, they are different from ordinary shares. Ordinary shareholders are the real owners of the company, and they are called the equity holders. Preference shareholders are not equity holders. Let's understand that. But we have two types. The redeemable preference shares, the word redeemed means that on the maturity date, you need to pay back how much we give you. And that is why redeemable preference shares act just like debt. But when you talk about irredeemable preference shares, they act just like equity. The word irredeemable means that how much you have invested, you are never getting it back. You do not redeem it. That share, the investment which comes with it, is irredeemable. Unless otherwise you want to sell your shares and go your way. That is the only point where you can get how much you invested. But if you are not selling your shares and you still want to be a preference shareholder all the time, then if it happens that you are not redeeming it, then that type of irredeemable preference share will act just like equity. So please get a distinction right. So it is not that at every point in time, preference shares act as debts. It depends on the situation. So you have indicated that the financial manager needs to know where he wants to get his funds from. If there's no funds, you need to know where to get it from. Later on, we will talk about capital rationing. There are some instances where you have all projects to be profitable and you want to enter into all of them, but you do not have the necessary funds to get all those numerous profitable projects done. In that case, we say that the little capital that you have, share them into bases and see how many of the projects can be done. So in effect, you ration your capital. You allocate. You apportion your capital to see which of the projects which can be done. And that is what we call capital rationing. Though we look at the types of capital rationing, soft and hard capital rationing later on. But today we are looking at financing decision, and we are saying that the financial manager takes a key decision of looking at where to get its sources of finance. And those providers of the finance can be equity holders or can be debt holders. And they are together called financiers. They are together called financiers. So we have equity financiers, then we have what debt financiers. If you say a financier, is somebody who is the person or the entity who gives you the fund, is who we call a financier. So we have two main sources of funds on this planet. It's either equity or debt. It's either equity or debt. Now, before we will say that we are going for a source of funds, the financial manager needs to sit down to do pros and cons to see which side, which source of finance do I have to go for. Maybe yesterday you were thinking about equity, but today equity is not good enough. What do? You go for that. So you do your pros and cons, you weigh them, then you now conclude on which of them you want to go for. That is exactly how it works. Now, this is an area which is really important. We are not looking at the document entirely. Looking at it in the case of lecture, we are not looking at that. We are at the debrief stage. And the debrief stage, on the day of exam, you know for sure that we have two main sources of funds. We have the equity source, we have the debt source. And the main goal of every financial manager is to maximize the worth of shareholders. And when we say the worth of shareholders, that means the benefits that shareholders get. Here we are specifically talking about the ordinary shareholders. We are specifically talking about the ordinary shareholders. The ordinary shareholders, they are the real owners of the company. They assume the highest form of risk. So equity holders, they are what? Really what? The highest risk investors, right? So one thing that we need to know is that this criteria for selection of a source of finance becomes an important issue to the examiner. So before we will say Jack, in the case of page 1, know that this is an area which is key, right? Nobody would like to examine financial decision without examining this bit. So you need to master them, understand them. The day of example, if it's about explanation, you should know how to explain them. Before we can say we are going for equity or debt, we need to look at some factors. Some factors will tell us, not that you just wake up and say you're going for equity or debt, right? So one thing that we consider is the cost of capital. The cost that comes with that finance or that capital you're going for. If I'm looking at equity and debt, and I look at the cost which comes with the two, and I think that equity is expensive, then what do? I can say I'm going for debt. So you have to weigh the cost which comes with the two, then you conclude on that, right? But know that the cost of the capital is what we are going to look at as the next topic, weighted average cost of capital, for short called by students WACC. So we have indicated that the financial manager only think about calculating WACC when he is looking at going for a source of finance. And because one of the criteria for selecting a source of finance is about cost, he is now going to calculate the WACC of every source of finance that he's going for. And the lower the WACC, the better the NPV of the project. And also the better the market value of the company. And also the better the share price of the company. Please, this relationship has been indicated in your lecture video. You need to still grab this concept because it is testable. It is really testable. The examiner will be beating you your mind just like that. Give you a narration. If we have this specific cash flows and the weighted average of capital was, let's say, 9%, given so and so, if the weighted average cost of capital increases by 2%, will the market value of the company increase or decrease? Those bits you need not to sit down and worry yourself. If it was 8% and now it is 10%, we are saying that a decrease in WACC will increase the market value of the company. But here, if the WACC is increasing, then the market value of the company will reduce. And if the market value of the company reduce, the share price will reduce. So please be very particular about this. Write this in your short note or formula book or for FM and ensure that you go through again because it's very important. So not only the cost we consider in looking at whether to go for equity or debt, we also look at the duration, the time duration. We also look at the term structure of interest rates, Then you look at gearing. There are some issues over here which we are not talking about because debrief, we do not waste our time on those bits. So the amount of debt that a company capital structure will have will show how geared that company is. And the company which is geared is having more of debt in its capital structure. And an increase in gearing as a result of an increase in debt, increases the financial risk and the risk of bankruptcy of the company. In deciding to go for equity or debt, you need to look at your gearing status. If we are having more of debts in our capital structure, then that means we need not to go for additional debt. In that case, the only option of source of finance is going to be equity. But if it happens that our debt component on the capital structure is small, then we can say that we can go for a debt as an additional sources of finance. So we need to know the pros and cons, when to go for debt, when we don't need to go for debt. Another thing that we consider is accessibility. I think, Carrie, want to ask a question or me to speak and come play?
Yeah, please, do they ask why debt is cheaper than equity? Is
But
that example?
they can ask you at any point in time. I think the recorded section, I explained that there's even another section, if I've not shared, that will really come up in the case of weighted average cost of capital, right? But it is a testable question. Why is debt cheaper than what equity? In this document, it even turns out to be in it, right? So why is debt cheaper than what equity? Because debt is cheaper than equity because the interest that we have to pay on debt is even tax deductible. It's even tax deductible. So if you go for, let's say, a bond or a debt of value of, let's say, 9%, you are not going to pay the 9%. At the end of the day, it is going to be 9%, 1 minus T. And the T is the tax rate. So the tax rate, if it is 30%, it becomes 0.3 or 0. So at the end of the day, instead of paying 9%, you end up paying 6.3%. Right? So we have issues of theories from Modigliani and Miller, 1958, 1963. We have those assumptions in there, but those bits are only seen when we talk about weighted average cost of capital topic, right? But one of the things that makes debt cheaper than equity is that, one, in the case of REX, equity holders tends to have the highest REX. And the highest REX should be compensated with the highest return. So since equity is having higher REX, what happens? Its return is going to be higher. And that's why equity is what? Expensive. So higher return. So that is why equity is expensive. So you can answer this question on the basis of REX. Debt is cheaper than equity because debt has a lower REX, and a lower REX investment will attract a lower return. And since equity is of higher REX than debt, it will call for an increase in REX. And an increase in REX will lead to an increase in return, and that will make equity expensive. Then we can also take it out from the point of what? Tax deductibility. So after picking REX and explaining with REX to defend it, that's why debt is cheaper than equity, you again move to what you call the tax shield or the tax deductibility. If we are to pay 9%, we don't pay the 9% because it's tax deductible. We now pay 6%. And the beauty about even this 6.3% is that we are not going to pay the 6.3, in bulk. We'll be paying them, let's say, yearly. If it's a 15-year bond, you'll be paying the interest more. And on the 15th year, you pay the principal. So then this is beautiful because of the characteristics that it tends to have. Right. So that is the explanation for you. When we get to the weighted average cost of capital, a lot of issues was to be said on that. So if we are looking at also source of finance, we can also consider the source of finance based on what? Accessibility. If you cannot access that fund, why do you have to consider that? Right? Good. Then we have short-term sources of finance. Over here, know the examples. You need to master the examples. We do not have currently operating lease, but for financial management perspective, know the distinction between operating lease and finance lease, right? Then we have sale and lease back, very, very important. If you talk about sale and lease back, we are looking at financial reporting. So look at that also. Disadvantages of sale and lease back is documented over here. You need to master those bits. We talked about two main sources of funds, equity and debt. I have still explained this bit over here. I think the last time I talked about one of the benefits that is attributable to the individual is based on the dividend paid and how much the company can also sustain for future sustainability is also based on the retained profit, which is also called the income surplus. So one of the things that we should know in raising equity, we said there are three main sources of equity finance. We have the internally generated, which is retained earnings. We have right issue. Then we have what? New external share issues, such as placement of offers, IPOs, all those things are what existence. Public offer, such as first price offer for sale by tender. Then choosing between sources of equity. This time we are not looking at equity and debt, but we are looking at if you have a lot of equities, what factors are you going to consider to say that you are going for this type of equity or that type of equity? So we still talk about accessibility to the finance, amounts of finance, the cost of issue of the procedures, right? We talk about them, pricing of the issue. These are very, very important. I explained dark pool trading system in that recorded lecture, right? So what I'm trying to say is that know the factors in deciding whether to go for equity or debt. That is really most important. It's really examinable, but not factors you consider in choosing within debt. You can just go and look at that though. But what is really of importance for the brief perspective is to know that we consider factors to consider or factors to consider when we are looking at either going for debt or what equity, right? So we have given some examples of debt, bonds, deep discount bonds, zero coupon bonds. I explained that beautifully. Instances where debt is issued at a premium, issued at par. I explained them beautifully in that recorded section. Finance lease is over here. Venture capitalists, beautiful guys. Advantages of debt. Debt is cheap. Cost is limited to the stipulated interest payment. There's no dilution of control, not like equity, where there can be dilution of control. And the fourth point is that it is a way of testing the competence of management. If you are going for debt, it shows your weaknesses, right? If you are not good, it will show. Just look at the situation of the country. Because they went for more debt and they couldn't manage it. Look at the situation of the country. So if you are going for more debt, if you hear that we are going for more debt and you are not a good manager, you need to start packing your tools, because whatever be the case, the debt that you go for, if you are not able to pay for that, your weaknesses will be exposed. So a lot of managers who are incompetent would want equity source than debt source, because debt source, you need to pay interest, you need to generate profit and pay that interest. Meanwhile, you are not competent. How do you generate the profit and pay the interest? So your weaknesses will be shown. Disadvantages of debts, we have elaborated a lot over here. So somebody will say the disadvantages of debts are the advantages of equity. A student talked about it. Henry, can't we look at it from that angle? I said, yeah, you can look at it. So the advantages of equity, whatever the case, become the disadvantages of debts. Okay, so we move on and on. Hybrid, we have some sort of finance, which tends to have partly equity, partly debt. An example is the convertible loan notes. We have also loan notes with warrants, very, very important. Then one important thing, some time back in financial management ACC paper, you cannot run away from, whatever be the case to be tested some time back, was Islamic finance. But it has quite diminished a little bit in the case of testability perspective. Notwithstanding, we still need to prepare ourselves for it. Notwithstanding, we still need to prepare ourselves for it. So I think that I explained a lot of detail pertaining to the principle of Islamic finance, where they believe that they are not supposed to earn interest on what? A loan. So if I give you, let's say, a loan, I still want to charge you interest. They say, that person was not even having the money in the first place. So if we are giving him the loan, why do you charge interest on that? So it is premised on the principles of the Sharia law, according to the Islamic law, which says that sharing out of profits and losses are to be done equally. No interest or riba is allowed. Finance is restricted to Islamically accepted transactions. No investment in alcohol, gambling, etc. Therefore, ethical and moral investing is encouraged. So we have sources of Islamic finance. The names are scary, but you need to put them in mind. So we have the source of Islamic finance. We have the murabaha, which is also called trade credit. In fact, it's acted in a conventional form. just like what? A trade credit, right? Good. Then we have Ijara. That is also in a conventional form called what? A lease what? Finance. A lease finance. They have the Sukuk. That is in the form of what? Bonds or debt. Bonds or what? Debt. Then we have the Mudaraba. That is acting just like in the form of what? Equity finance. If you know the name in Islamic perspective and know the equivalent name in English, it really helps you, right? They have the Musharaka. That is what you call what? The venture capitalists. You know for sure that venture capitalists, they look at where it is really profitable. They invest in it. They invest in it for some time. After getting all the benefit, they sell that company and go their way. So we say these people are shakara guys. They are shakara guys. So venture capitalists, they are in Islamic perspective, we say what? Musharaka. Musharaka. If you can recall Musharaka, then you should be able to recall Mudaraba. Musharaka, Mudaraba. Then you should be able to recall Sukuk, Ijara. You see those big, you should be able to recall them. The Mudaraba, right? Mudaraba, Musharaka. Then this confuses, right? The trade credit, Murabaha. That is the only one which confuses. But Mudaraba, Musharaka, Sukuk, Ijara, those bits are easy to pronounce and they are easy to recall. But Murabaha, that is the side where it becomes complicated for me. I do not know how you see it, right? But I think that the detailed explanation is in here, and also the recorded section provided that. But it's also an area from the brief perspective, also happens to be an area of importance to the examiner. Just go through that and ensure that you are fine. So in effect, if the student is not fine with the above issues, we have provided in a tabular form summarized versions of those issues to help you explain. For example, if you can explain by these things, we'll give you full mark, right? So Murabaha is similar to and acts just like trade credit. So there is a pre-agreed markup to be paid in recognition of the convenience of paying later for an asset that is transferred immediately. There is no interest charge. You can write this on top and give you full credit. Musharaka. So act like venture capitalist smart guys. Profits are shared according to the pre-agreed contract. There are no dividends paid. Losses are shared according to capital contribution. The last bit, we have Mudaraba, equity. Profits are shared according to a pre-agreed contract. There are no dividend paid. Losses are solely attributable to the provider of the capital, just like equity. The provider of the capital losses, he only takes the losses. Leasing, Ijara. Whether an operating or finance transaction can be operating lease or finance lease. In Ijara, the lessor, still the owner of the asset, and incurs a risk of ownership. This means that the lessor will be responsible for major maintenance and insurance, which is different from a conventional finance lease. Sukuk. There is an underlying tangible asset that the sukuk holder shares the risks and rewards of ownership. This gives the sukuk properties of equity finance as well as debt finance. So you can have the equity form of the debt. Benefits of Islamic finance is you can read them to keep yourself okay. Disadvantages or limitations of Islamic finance are here. You can read it and keep yourself okay, right? But they are very, very important to read. Then come to financial markets. So financial markets is where lenders and borrowers trade. Simple. Financial market is where lenders and borrowers will trade. So we have some examples over lenders and savers, some examples over here showing the flow, right, of movement. Direct investment, this picks up, it goes to the government releases part to the customers, releases part to the inhabitants. The inhabitants use that to make their business, get money, pay taxes, go back to the government, rotating funds throughout and over and over again. So you have the capital and money markets. No, the capital market, no money market. They say money market is a financial market where lenders and borrowers operate in the short term. Capital market is a financial market where lenders and borrowers operate in the long term. Capital market is a financial market where lenders and borrowers operate in the long term. Money market It's a financial market where lenders and borrowers operate in the short term. So in every definition I start with, it's a financial market where lenders and borrowers operate. I need to take my time. If it's money market, I'll say short term. If it's capital market, I say long term. Easy peasy. We have the primary and secondary markets. We say a virgin market is what? A primary market. That is where initial public offering is mostly what? Done. Secondary markets is a market over and over again. There has been sale, trade between brewers and what lenders in there. Then advantages of secondary markets. We can also look at the advantage of secondary market as the disadvantages of primary markets. So this happens to be the advantages of what? Of advantages of secondary markets. So you can look at it from that. You can talk about diversification. You can talk about risk shifting. You can talk about hedging. You can talk about them. Then you can talk about arbitrage. That is the profit that is made. If you bought a shares to be 5 Ghana cedi today, and tomorrow it is 10 Ghana cedi, or let me say 5 Ghana cedi before, it is 8 now, the difference of 3 becomes your arbitrage what? Profit. Becomes your arbitrage profit. Let's also understand the distinction between exchange traded markets and over-the-counter markets. In futures, we have something called futures contracts. Futures are all the time traded in an exchange derivative market or an exchange traded market. But something like forward contracts, something like options, something pertaining to, let me just talk about options. Let's talk about options. Let's talk about swaps. They are all the time traded over the counter. When you say over the counter, some students do not understand. It's just like going to the bank and standing behind the counter and just discussing with the cashier. That is the counter or the teller. So you say over the counter. That is it. It's not anything different, right? But exchange traded market is when we have, let's say, like the Ghana Stock Exchange, where we have formal rules and regulations available. And in an exchange traded market, it is difficult for defaults to happen. Somebody cannot come take money and will not pay for that. So we say the exchange traded market, we have formal rules and regulations, which reduces the risk of what? Defaults. That somebody will come for your money and will pay. But over the counter market, we do not have that formal rules and regulations. There's that susceptibility of what? Defaults. There's that susceptibility of defaults. Then we come to financial intermediaries. They are individuals, firms, government that tend to link lenders and borrowers. We can talk about banks, tends to link brokers. That's sort of examples of financial intermediaries, commercial banks, finance houses, mutual societies, institutional investors, example, pension funds, investment funds. These are there. The benefits of financial intermediation. What are the benefits of, it's just to say what are the benefits of financial intermediaries. Or we can even say, you can just pick an example. Give us what? 3 benefits of commercial banks. It's the same what? Because a commercial bank is an example of financial intermediary. They say, give what? 4 or 5 importance of finance houses. You can still give this point, A, B, C, D, E. Because a finance house is an example of a financial intermediary. And a financial intermediary goes through financial intermediation. And we have benefits of financial intermediation. 1, they provide obvious and convenient ways in which a lender can save money. Easy what? Peasy. Financial intermediaries also provide a ready source of funds for borrowers. They can aggregate smaller savings deposited by savers and lend on to borrowers in large amounts. Risk for individual lenders is reduced by pooling. So it's reduced by pooling. By pooling the funds of large number of people, some financial institutions are able to give investors access to diversified portfolios, covering a varied range of different securities, such as unit trust and investment trust. Financial intermediaries, most importantly, provide maturity transformation, either borrowing money on shorter time frames than they lend out. They bridge the gap between the wish of most lenders for liquidity and the desire of most borrowers for loans over longer periods. So we also talk about hot stock markets. So we can talk about Ghana Stock Exchange. Then we come to one theory, which is really testable, efficient market hypothesis. During the beginning of the period, I think one of the politicians, in the case of Opon Kroma, said that they are going for money from IMF and that when they go for money from IMF, the dollar will lose value. That guy was having a lot of issues. In fact, what he mentioned in the normal context, he was just beating the minds of a lot of people. He wanted people to sell their dollar. Meanwhile, they knew for sure that the dollar is going to mess up. So certain information which comes into the financial market scene turns out to impact on investors' decision making. And that is what we call efficient market hypothesis, for short, EMH. So the efficient market hypothesis, or alternatively known as the efficient market theory, is a hypothesis that states that share prices will reflect all information. According to EMH, stock always trade at their fair value on exchanges, making it impossible for investors to purchase undervalued stocks or sell stocks for inflated prices. Therefore, it should be impossible to outperform the overall market through expert stock selection or market timing. So we have types of this efficient market hypothesis. We have the weak form efficiency, we have the strong form efficiency, we have the semi-strong form efficiency. Please be mindful of this. With weak form, we say that the value of the stock price will reflect past information of auditors' reports, which has been published on the website of the company. Then semi-strong, you have past information plus current information. Then in the case of strong form, that is mostly done by used by a lot of insider dealers. Insider dealers tend to use that for insider dealing. Certain information that is not available in the past scene or past information is not also in the current market domain. Insider from, let's say, the CEO or whatever. So there shouldn't be insider dealing. Insider dealing is actually illegal, and you're not supposed to do that. So we have types of financial market instruments. We have the CDS, we have the repos, we have the certificate of deposit. These are examples of money market short-term form of securities. You can read on and on and on, honestly. Certificate of deposit, if it's your first time of seeing that, you can read through. Sale and repurchase agreements, which is for short called repos. You can read that. Treasury bills, I think treasury bills, treasury bills. We have commercial bills, we have derivatives, short-term. Example of derivatives are forwards, contracts, forward rate agreements, FRAs, futures, options, swaps. We'll come back to this again when we're looking at risk management. So we decided to also look at cost of capital, WACC, also here. That's why the topics are in order, right? So the cost of capital is the rate of return that the enterprise must pay, to satisfy the providers of funds, and it reflects the riskiness of providing the funds. I've explained this bit already. The quarter session will throw more light on that. So I went through this calculation. The case of the theory tuition phase, please look at that. But you pick WACC on its own, right? WACC specifically on its own. So this is how to calculate the share price, but this is not mostly used in current situation. This is the formula we use. Cost of equity can be calculated as D over PO, where this D is the current dividend after growth. So I talked about cum div, ex div. I explained those bits. Please go through that. This topic was actually treating WACC, which I'll share with you the recorded section. So if you have not understood it perfectly, please just be on standby for the recorded section. You have dividend growth model, way of determining the price. Please, your price is your value. Your price is your value. Your price is your value. Then we have estimating the growth rates. This is formula to estimate growth rates. The GIN, using Gordon growth rate. Can use the averaging method or can use the Gordon's growth model. So just go through the recorded lecture. I'll share with you that of WACC and keep you okay. So at least let's move through this. Recorded session will come to support you. Probably you have gone through them already in the case of this financial decision topic, but you still need to go through over and over again. So you have the weakness of the dividend growth model, which assumes that things are constant, but in rare situations, they are not. So CAPM, capital asset pricing model, please just be reading these bits. Beta, but the recorded session will still throw more light on them, right? So we have types of beta. We have the equity beta. We have also the equity beta. We have the asset beta. These issues are not important and that do not waste your time. Slope method, forget it. Covariance method, forget it. It will not be tested. So do not waste your time when you come here. Correlation method will not be tested. The ways of calculating these betas will not be tested. We have a way of calculating our beta, right? Good. So let's be very particular about them. We will still pick WACC. These are still some examples. Here what are we calculating? We are calculating the cost of equity, which the cost of equity is calculated as what? KE is equal to risk-free plus equity beta into bracket, risks on the market minus risk-free. So we have the risk-free rate to be what? The risk-free rate here is 4%. So if it's 4%, we put it here. Then we say plus. Then what is the beta? The beta over here is 0.9. That means it's not too much risky. Please note that. A beta of 1.2 is risky than the beta of 0.9. Put it in mind. The examiner can deceive you. A beta of 1.1 is riskier than the beta of what? 0.9. So we have it to be 0.9. It's expensive, right? Brackets, we have it to be 10 minus 4. So at the end of the day, we have 5.4 plus 4. That gives us 9.4. If you subtract 4 from 10, you get 6. 6 times 0.9 will give 5.4. 5.4 plus 4 will give you 9.4. So that is how you go through to get this 9.4 over here. Then move on. Some calculations over here. What will be the expected rate of return from ordinary shares in BB, which have the expected rate of return is the cost of equity. So here you need to calculate cost of equity, right? Cost of equity. And cost of equity is what? The normal thing, KE, cost of equity is equal to the risk-free plus the equity beta. The company is having debt and equity. The beta is equity beta. Risks on the market minus risk-free. The company is only having equity. We say asset beta. So here we have the risk-free to be what? We have the expected return to the market as 7. Investors have expected rate of return of 8 from an ordinary shares in ABC, which is okay, that's fine. So one thing we need to know is that we need to be very mindful of this sort of analysis. What will be the expected rate of return from ordinary shares in BBC Co, which has a beta of 1.8? So you have to pick them one after the other and estimate, right? So we pick them one, then we estimate. But do not forget, we still have to estimate the risk-free rates. But here we do not have the risk-free element. There should be a risk-free element in the question. But here the examiner is saying that the expected returns to the market are 7. So we have the risks on the market to be 7. So we have the risks on the market to be 7. Then you need to find a way of estimating the that is the risk-free rate. But here, that is exactly what we are going to compute. Watch what we are going to do basically. So the rate of return of an 8% ordinary share, so we are saying that the KE here is 8%. And if the KE is 8%, we are saying that the risk on the market is 7. We do not know the risk-free, right? So say 7. I can say 7 minus X, right? Then I have the beta. I have the beta, testing a little bit of mathematics. I have the beta to be 1.2. So I'll put here still X. And I think at this point in time, you should be able to solve. I think at this point in time, you should be able to solve for X. So here, when you get the X, that becomes the risk-free rate. Then the risk-free rate you get over here. So let's solve it, right? Let's solve it. Let's not be a coward to run away. So you have what? X plus, what is 1.2 times 7? It will give us 8.4. You can do your math somewhere, but I think that is it. Then here minus 1.2 what? X. So what do? You have X minus 1.2X. Let me group like terms. So I have here to be 8. The 8.4 is positive. It crosses to be 8.4 here. Is equal to X minus 1.2X. So what happens? We are going to get the answer to be negative 0.2X is equal to negative 0.4. And when you divide both sides, you need to divide both sides by what? You need to divide both sides by a negative 0.2. So here, divide also here by negative 0.2. Negative 0.2. So at the end of the day, what answer are we getting? 0.4 divided by 0.2. I think get the answer to be 2, right? But you can do the math wherever you are. And let's see. I'm picking my calculator. If you get the answer, can give me so that we will move on. I'm not in 0.4 divided by 0.2. I think the answer is 2, right? So at the end of the day, we get the 2 over here. And now that you have gotten the 2, what does the 2 stands for? The risk-free rate. So now that you've gotten the risk-free rate per the information above, the examiner says that if I've now gotten the risk-free rate, what will be the expected rate of return? You know, the first ABC code, they gave us their rate of return, which is the cost of equity. The cost of equity is in the eyes of one person a cost, but in the eyes of another person a return. So over here, calculate the cost of equity of BBC code. The first one they gave us was ABC code, and their cost of equity was 8. And we used the 8 and the beta and the rest on the market to estimate the risk-free, which is 2%. Now that they are saying that the beta is at this current situation 1.8, use that information together with the risk-free rate to calculate the cost of equity. So here the cost of equity become the risk-free rate, which we know for sure that is now 2%. So here, ABC Co. is a proxy company. It's a company which is in the same industry, just like BBC Co. So the risk-free rate of ABC Co. become the same risk-free rate for BBC Co. Because we say that companies which exist in the same industry tends out to have the same business risks and will have the same risk-free rate. So we have 2% over here. Then we have 1.8 instead. We have risks on the markets. The risks on the market is the same market of those guys, right? So you have 7 minus 2, right? So what answer are we getting? We end up getting 2% plus. Now, what is 7 minus 2 here? 7 minus 2 here is what? 5. So what is 5 times 1.8? So barely, it will give us something like, I'll just say 9. I think so. Something like 9. So 9%, you can do the math somewhere, but I think it's 9, though I'm using my head. So 11%. At the end of the day, here, the cost of equity is 11%. Now, I want you to check something. When the beta was 1.2 in the same industry, what was the return? The return was 8%. Now, when the beta increased from 1.2 to 1.8, do you expect the return to be small? No, because the beta measures the risk. And when the risk increases, the return or the cost should also increase. Please check that. So no wonder we have it to be 11%. That was what the statement I made earlier. So an increase in the beta, which measures the systematic risk, will lead to what? Will lead to an increase in cost of equity, which is also called the return on equity. So if the cost increases, if the risk from the beta increases, there's going to be an increase in the cost. And that's why I said that if the risk is increasing, the investor would want to be compensated by more benefits. Right? Good. So these are CAPM assumptions. You can read on the CAPM assumptions. Well-diversified investors, they have perfect capital markets, or restricted borrowings or lending at a risk-free rate of interest. Uniformity of investor expectations is uniform. Yes, investors' expectations are uniform. All forecasts are made in the context of one-time period only. Problems of CAPM. So the problems of CAPM, one of them, they need to determine the excess return. That is the risk premium. The difference between the risks on the market and the risk-free rate is called risk premium, right? Good. Sometimes they don't give the risk on the market. They'll give the risk-free rate. They'll give you the risk premium. Know what you. So these are some assumptions. Please read through and ensure that you are fine. Here we decided to bring in the types of debts, right? Irredeemable, which acts just like equity. Redeemable, which acts just like debt. We have the convertible form of debt, which is a hybrid. It will be in the form of debt. It can be converted to shares or equity thereafter. some readings over here, not really to die for though, but you can just read through to keep yourself okay. Ways of calculating the cost of irredeemable debts. This is the I here is the interest rate, right? And P here is the price. So the I can be the coupon rate also. So based on, so first of all, we are calculating cost of irredeemable preference shares. Cost of irredeemable preference shares. So in calculating the cost of irredeemable preference shares, say KD, K of irredeemable preference shares is the coupon rate. What is the coupon rate? Let's read that. So they are saying that which is the same as the interest. Coupon rate is the same as interest rate. ABC Co has issued loan stock of $100 nominal value with an annual interest rate of 9% per year. So the interest rate is the coupon rate. So put the year 9. The current market price is 90. So 9 over 90 would give us what? 10%. This is how to calculate what? The cost of the loan stock, which becomes also the cost of the sources of finance. Then if interest on loan capital is paid other than annually, what do? You can compute it in this form, but not mostly. This is not mostly testable. So let's be okay. But you can learn it just in case. Henry has 12% redeemable debentures in issue with a nominal value of 100. All the time, these are quoted at par 100. Just say the $100 like sack. Every sack of debt 100, right? The market price is 95. Anytime the market price is 95, but meanwhile it is at 100, you know it is issued at what? A discount. Calculate the cost of capital if interest is paid half yearly. Half yearly means semi-annually. That means semi what? Annually. Semi-annually. So this is how you compute it. If it's not computed, it's not paid once and it's paid several periods. So compute, you get what? 13%. Learn it just in case. They have the redeemable debts. Here we use this formula in calculating that, right? But if you want the recorded section, the case of WAC, I use a different perspective. What did I use over there? I said that the PO is the coupon rate. The I here is the coupon rate over 1 plus the KD here is the interest rate. So to the power 1, to the power 2, to the power 3, up to infinity. That will help you give you. The P here is the price, and it's all the time at what? 100. Right? So just like the example, you can say PO is equal to 9. Watch that. You see 9 divided by, they divide it. You see 1 plus, let's see, the interest rate is 10%, so 1.010. They say to the power 1. They move on, plus 9. You see that bit? You do that over and over again. You also divide it. They say 1 plus 0.10, but this time around to the power 2. They move on like that, right? Good. So the last year, if it's 3 years, the last year is going to be 100 plus 9. Sorry, it's going to be 100 plus 9. Then you put it also in brackets. Put it also in brackets. 1 plus 0.10, right? Open your brackets here. You close it at the other side. But this time around to the power 3 is closed. So if it is 3 years, note that at the redemption period, which is the 3rd year, you pay for the principal, which is 100, plus the interest, which is 9. And that's the beautiful thing about bonds. If it's a 3-year bond, year 1, you pay the interest. Year 2, you only pay the interest. But on the 3rd year, the redemption year, you pay the principal plus the interest. And that's the beauty about what? Bonds. So just go through that. This is a perfect example showing you how to discount cash flows. The discount factor is 12%. The discount factor of every item, discount rate in year 0 is 1. So that gives us 1. But the discount factor, here we are looking at 1 to year 10, and we use annuity factor instead of discount factor. So you can calculate the annuity factor over here. I've showed you how to calculate annuity factor. I said annuity factor is calculated as 1 minus into brackets 1 plus r, right? 1 plus r to the power minus n, all divided by r. So this is the formula to calculating what? To calculating annuity factor. So this 5.650 that we put here, if you don't understand how we got it, you can compute it easily. So the annuity factor is going to be 1 minus, open your brackets, 1 plus r. Here, what is the rate? The rate is 12%, so 0.12. Please don't make it 12, make it 0.12 to the power. How many years? Here they are having 10 years, so say minus 10. You can compute that wherever you are. You see if you get the same answer. You get the same answer. So we have to the divided by 0.12. If you do the maths by punching out, you get 5.650. That's the annuity factor. So you put that here. Then you can do the same for annuity factor of 11% for year 1 to year 10. You can put that also here. It's just a matter in that the formula by changing this 0.12 to 0.11, also changing this to 0.11, because the R here, it turns out to be 11%, not 12%. Yes, your question, please.
Yeah, Henry, please, did you say annuity factor?
Can you come again?
Did you say annuity or discount?
Hello? Please, can you amplify your voice? I'm not hearing from you, please. Can you, if not, you type. If not, try and see if you can type. Okay, I've increased the volume of my set. Can you come again? Hello? I'm saying that I've increased the volume of my set. Can you come again? I was not hearing from you. Hello? Hello? Your voice was coming clearly in the beginning. I don't know why it's not, working out.
Please, can you hear?
Yeah, it's okay now. I don't know what is happening, but you just ask your question. It's clear now. It has gone back. I don't know what you did earlier on. That's why it came very good, but it has gone back. I can't hear from you again. I don't know whether you picked you are using a laptop, you inserted your earpiece and you moved the earpiece and you spoke. I don't know how you went about it, but when you said, please, can you hear? It came very clear. I heard you, but today after, I can't hear from you again. Okay, that's fine. We say an annuity factor when we are looking at a lot of years. You know, here we are looking at the annuity factor because we are looking at the factor for year 1 to year 10, not just one single year. We only say discount factor when you are looking at the rate for just 1 year. If it's just for only year 5, we say discount factor. If it's only for year 20, we say discount factor. But if we're looking at from year 1 to year 5, multiple periods, we say annuity factor. So that is why we are not using discount factor here. But here we say what? Annuity factor. But look at that. Look at the last period. The last period, we are only looking at what? Year 10. And because you are looking at only year 10, this 0.322 is not an annuity factor, instead a discount factor. So if we're looking at multiple periods at the same time, we say we use annuity factor. If we're looking at just a single period, we say discount factor. That's why in the other recorded session, I said that annuity factor is made up of multiple discount factors. Right. So you do the same over here. If we're fine, please, let's move on. If we're not fine, drop your question again. So if there's a problem with the sound, it is not a problem. I think I've seen your question by the chat and I've responded. So if over here, because at this point in time, we are using a discount factor of 12%, a rate, let me just say a rate of 12%. And we got this annuity factor for year 1 to year 10. And here we got that. You see, the reason why this line is up to 1 to year 10 is that though it's a 10-year bond, you'll be paid the interest from year 1 to year 10. Then on the 10th year, you now pay the capital, the principal itself. And the principal is quoted at par 100. But the 10, which was the interest, will be paid from year 1 to year 10. So the interest will be paid from year 1 to year 10. But the principal will only be paid on the last year, which is year 10. And since the last year rate is a discount factor. But the interest will be paying from year 1 to year 10 is multiple. We say when you talk about annuity cash flow, these are cash flows which are the same for all periods. So year 1, you pay 10, year 2, 10, year 3, 10, year 4, 10. Do you have to pick discount factors one after the other? No, to be a waste of time. Because they are the same cash flows, we use annuity factor to multiply it. We go away. Okay, let's move on. So over here, the rate was 12%, and we got the discount factor for year 0, also just 1 year. So say discount factor. The discount factor all the time year 0 is 1. Here too, you can see when the rate was 11%, the discount factor year 0 is still 1. But over here, the annuity factor of 12% for 10 years is 5.650, and 11% is 5.889. We have the discount factor of 11% for year 10 to 0.352. So at the end of the day, when you compute the present values, you add up, right? How do we get this 90? It is this 90 here negative times 1, and that gives us this 90. Here it is this 10 times 5.65, which gives us 56.5. Here it is this 100 times 0.322, which gives us 32. Then you add them up. So minus 90 plus 56.5 plus 32.2 will give us negative 1.3. Then the same bit, how do we get this 90 over here? It was this 90 cash flow times the discount factor here that gave us this 90. Then how did we get this 58.89? It was this 10 here multiplied by this 5.889 gave us 58.89. How did we get this 35.20? It was this 100 times 0.352. So all the time is the cash flow times the discount factor will give you the present value. Cash flow times the discount factor will give you the present value. Then you sum them up. When you sum them up, you get 4.09. So over here, what formula are we using over here? We are saying using internal rate of return to calculate cost of debt. Using internal rate of return to calculate cost of debt. This formula over here, we are using internal rate of return to calculate cost of debt. Given an interest rate of 10% with a market value of 90, computes the cost of debt. And we use the IRR method, internal rate of return method, to calculate what this cost of debt, right? So we say the lower rate, if you remember, we say the lower rate, IRR, that investment appraisal technique is what we use to calculate this. So we say the lower rate, if you remember, plus, then we say the lower rate so sorry, I got it. NPV of the lower rate divided by NPV of the higher rate minus NPV of the lower rate times into brackets higher rate minus lower rate. So this is a way of calculating what that. So when you look at the rate, the two rates, the first rate was 12%, right? The second rate was 11%. So what is the higher rate here? 12, right? So over here, when the formula is lower rate, you start with 11. No wonder we started with 11. Then the NPV of the lower rate. The lower rate, which was 11%, what NPV did they give us? It gave us 4.009. So you put it here by the formula. I'm just following you, right? So 4.09. So all divided by this divided by the, so start with the NPV of the lower rates. I made a mistake over, it's supposed to be lower rates minus higher rates. Lower rates minus higher rates, right? So that the negative will give us that. So you see, you have 4.09 minus, then we already have the NPV of the higher rate to also be minus. So minus become plus 1.30. So negative meeting becomes plus. So times into brackets The higher rate 12, one is the lower rate. That is it. And when you do the maths, you are going to get 11.76 what percent. Okay, so we move on. Debt, capital, and taxation. This is where we say that when there exists what? Debt, it is tax deductible. So it is the interest rate I, 1 minus T over PO. The other bit that we looked at for the irredeemable debt, it was before tax, but this is after tax. After tax means you take tax out from it. And how do you take tax out from it? It's 1 minus T, right? So divided by PO. The only thing we brought here in the numerator is by bringing 1 minus T, right? So that is a way of calculating cost of debt also after tax. Then we can use the internal rate of return, which I've already demonstrated. Here, a company has in issue 12% irredeemable debts. 12% irredeemable debts. So the 12% is telling us that it's the interest rate. So the interest, we are trying to say that the interest is what? 12%. And if the interest is 12%, how much do we pay? The tax rate is what? 30%. If the interest is 12%, will we pay 12%? No, tax deductibility, tax shield. So going to be 12 into bracket 1 minus 0.30. And this will technically give us 8.4. So instead of us paying 12%, because of tax deductibility, we are now paying 8.4%. So the examiner went on and said that a company has an issue 12% redeemable debt with 5 years to redemption. Redemption is at par. That means it is issued at par, right? The current market value of the debt is 107.59. The corporate rate is 30%. So we need to calculate the cost of debt. So how do you calculate the cost of debt over here? We need to calculate the cost of debt using the internal rate of return approach. So this is the format. Please master this format. You want to use the internal rate of return approach to calculate cost of debt. You put here Z here. Then you put discretion over here, right? Discretion here. Then the next thing is going to be cash flow. Then you put discount factor. At the end of the day, the discount factor here plus the cash flow give you the first present value. They introduce another discount factor with a corresponding present value, because the first side will have one discount factor to deal with. The last side will have another discount factor. Here we use 10%. The other side we use 5%. That is it. So we know for sure that instead of paying the 12%, we are ended up paying 8.4. So the interest rate from year 1 to year 5 is going to be what? 8.4. But that 8.4, because you are paying for 5 years, we use the annuity factor of the 10% for 5 years, which is 3.79. Then the market value was 107.59. The discount factor over here, since it's 1 year, is 1.0. Still give us 107.59. When you multiply 0.4 times 3.791, gives us 31.84. Then on the 5th year, we are now going to pay for the principal, which is 100. And the discount factor of 10% for year 5 is 0.621. So when you multiply the 100 by 0.621, you get 62.1. So you add up negative 107.59 plus 31.84 plus 62.1. All the time, note that the market value is in brackets, right? Note that. So then we get negative 13.65. Then we introduce what if the discount factor is 5%? You know, with internal rate of return, which you come across later, we said that the discount factors have a negative relationship with the NPV of the company. So the higher the discount factor, the lower the NPV. When the discount factor was 10%, what happened to the NPV? The NPV was what? 13.65. But when the discount factor reduced to 5%, you can see that the NPV has increased. So we all the time say there's an inverse relationship between NPV and the WACC, or the discount factor. So if you have done that, you still use the lower rate plus the NPV of the lower rate, that formula, NPV of the lower rate minus NPV of the higher rate times the higher rate minus the lower rate. You still get 6.72. Okay, so let's move on. Convertible debts. These are debts which can easily be converted towards to shares. Please, you make a reading over here. We need to calculate what the conversion ratio on the day of exam if we are given what a convertible debt. And how do you calculate the convertible debt? Is the nominal value or the par value of the bond divided by the conversion price. And what is a conversion price? This gives the price of each ordinary share obtainable by exchange on convertible bond. So a conversion price is the nominal or par value of the bond divided by the number of shares into which the bond may be converted. A conversion premium, this gives the difference between the conversion price and the market price. A premium is something extra, right? Now let's take this question. So conversion premium, we say is for sure called a conversion price minus the market price over the market price times 100. Please note this. A conversion premium is calculated as the conversion price minus market price over market price times 100. Now, beautiful question over here. Do we provided the solution? Let's look at it. A company has issued $60 million 15-year 8.5 coupon bonds. So the 8.5 coupon bonds is telling us that the coupon rate or the interest rate is 8.5. Is there any element of tax? I can't see anything like that. With a par value of 100, each bond is convertible into 40 shares of the company ordinary shares. So it's a debt or a bond which is now converted to shares. It's having a hybrid characteristics, which are currently trading at 1.90 required. What is the conversion price? Conversion price is easy to calculate. We said the conversion price is the nominal value. The nominal value is 100 over the number of shares that can be converted, which is 40. And that gives us 2.5. Please master this simple calculation. When you do an exam, it becomes complicated for every student. But those who have mastered it are cool. Conversion price, how do you calculate conversion price? It is the nominal value or the par value divided by the number of shares that will be converted to. That gives us 2.5. Conversion premium is the conversion price, which we got 2.5, minus the market price over the market price times 100, and that gives us 31.6%. Then the conversion value is the current market price times the number of shares that will be converted to. So non-tradable debts, for the purpose of reading, please, you can read this example, just be reading. The rest are reading, which I would want you to do. Funds, WACC, as I've indicated, the whole lecture will come on it, but I'm just rushing through. This is a formula to calculate WACC. VE here stands for the value of equity. VD stands for the value of debt. KE stands for the cost of equity. KE stands for the cost of equity. KE stands for the cost of equity. T stands for tax. KD stands for cost of debt. You need to know how to calculate these individual items one after the exams, and one after the other on the day for exams. There are some moments where we calculate WACC based on book values, but that's not the best thing, because why do you calculate WACC based on past information? You calculate rather WACC based on market values. That's the current value at the moment, and it's best to calculate WACC on that basis. We have some special example over here which will help you calculate WACC. An entity has the following information in this statement of financial position. So they are having ordinary shares of 50 cents of 2,500. Know that this 2,500 is the money we realize after issuing the shares. But what is the number of shares? So over here, the number of shares can be calculated as the money we realize, the money we got, which was 2,500. You know, it is 3 zeros. We bring that 3 zeros. Then divided by what? We divide it by 50 cents means like 50 pesos, right? 50 cents is like 50 pesos, so 0.50. So that is it. Basically, you get like 5 million, right? This is something like 5 million. 5 million shares. This you get something like 5 million shares. So this is the total number of shares available. And we have a 12% unsecured loan note, which is what? A 12% unsecured loan note, which is what? 1,000. The ordinary shares are currently quoted at 130 cents each, and loan notes are trading at $70 per $100 nominal. The ordinary dividend of 15 cents has just been paid with an expected growth rate of 10%. Corporation tax is 30%. I want to really solve this question because it is just like a normal question which can come for 2 marks. It's just like a normal question which can come for 2 marks. So you need to be what? Alert. Now, what is the question saying? Calculate the WACC for this entity. If you know your formula, you should be fine. But in the formula for WACC, we need cost of equity, cost of debt, the value of equity, value of debt, we need a tax. So we need to compute them one after the other. Here, what did we want to do? We wanted to compute the value of equity. And the value of equity is the number of shares. How do you get the number of shares? The 2.5 divided by 0.5. That will give us 5 million. And that value times 1.3. So to calculate the value of equity, let me put it in formula. The value of equity is calculated as the number of shares times the price per share. But earlier on, we didn't know the number of shares. So how do you get the number of shares? You open a bracket, you see 2,500. It is in millions. You can add the 3 zeros. Or you can decide to ignore, right? Just like what the examiner did. So then you divide it. Sorry. So then you divide it by that. Sorry. So you divide this. They come here to say 0.50. That will give you the number of shares. Dividing 2,500 by 0.5 will give you the number of shares. Then multiply by the price per share. The price per share is 1.30. So you get, what answer are we getting? We get 6.5. Then the loan notes, the examiner gave us information to estimate the loan notes. It is saying that it is currently trading at $70 per 100 nominal. So what do you do? What is the current value of debt? It's 1,000, right? It's 1,000 over here. And it's traded at 72 over 100. So to calculate the value of the debt, calculate the value of the debt, it is the traded value or the market value divided by the nominal value. Please watch this. It confuses some students. Divided by the nominal value times the book value of the debt. That's the book value of the debt. So over here in the question, the tradable value was $72. $72 divided by the nominal value. The nominal value was $100. The nominal value was $100. Then multiply by the book value. The value in a book so far, a book value is not the market value. Why are we saying it's a book value? Because the examiner said an entity has the following information in its statement of financial position. So it is indeed book value, right? But we want the market value. Because if you have indicated, it's best to calculate WACC using market values. And that gives us what? 1,000. So when you multiply the two, at the end of the day, you get 6,500 for the top, you get 720 for the down. That is the low notes. Please master the two ways of calculating the value of equity and the value of, master the way of calculating value of equity and value of debt. It is very useful in either section A, section B, or section C. So at the end of the day, we have the total market value. The capital structure is made up of 6,500 of equity, 720 of what? Debt. This company is not geared because the debt composition is small, very small, right? Good. So let's see. So we have the value of equity, we have the value of debt, but we have KD, KE. You see, where are we looking at this from? We have the VE here now. We have the VD now. We don't know the tax. We don't know KE. We don't know KD. If we know VE and VD, why don't you go and calculate KE and KD? So see, you have to put the formula down. Then those things in the formula, you search for them in the question. If they're not in the question, you need to calculate them. That is it. So just like this VE, the value of equity, and the value of debt, please do not go and use the book values. Here, the book value of the equity is 2.5. But what is the market value? 6.5. Here, the book value of debt was 1,000. But what is the market value? 720. Be mindful in how to convert book value to a market value. And I've showed you here, VE here, and I've showed you VD here, right? So now we are going to calculate, we have VE, VD, we are going to calculate KE, KD. So how do you calculate cost of equity? We can calculate cost of equity either using the capping method or using the dividend valuation model. But what is available here is the dividend valuation model method, which says DO 1 plus G over PO plus G. So the DO is the dividend, which is 0.5 times into bracket 1 plus G. The growth rate is 10%. For the example, give it to us over here, that is 10%. So 10% is 0.10 or 0.1 for short, divided by the PO, which is the price. And they indicated that the share price is 1.3. So plus G, plus G. So note the formula, put this formula in your formula sheet. Know that we have two ways of calculating KE. You can say the DO 1 plus G over PO plus G. So that gives us 22.69. Then how do we calculate? We can also use the CAPM method. Do not forget the CAPM method, where we said the CAPM method is KE risk-free plus the beta, right? Risks on the market minus risk-free, right? Master that. So the cost of loan notes of loan stock, it is just the interest rate over the share price. So you have that to be 60. So at the end, you have KE, you have KD, right? KD is 16.67. So you have the one formula repeated here. So you put the values in it. The value of equity is 6,500. The total value of equity plus value of debt, when you combine it, you get 7,200. And the cost of debt is 22.69. The value of debt is 720. The value of equity plus the value of debt is 7,200. Then the KD is 16.67. 16.67. But it's good to take tax out of it, right? Capital structure decisions, these are theory, and that is what we call the capital structure theory. On the day of exam, please remember to take the tax out of it. If here we didn't take the tax element out of it. Yes, your question.
Honey, please can you take the tax out when you're calculating the cost of loan stock?
Yes.
So it will be 0.12.
Yes.
And so 1 minus
T, which is the 30%, 0.30 divided by 0.72.
All right.
Thank you. The concept.
Yeah.
Right. So remember to take that. It's very, very important you take that into account. Okay, so we move on. So you not get the same 21.59 if you consider the tax. So traditional view, these are the theories of what? A WACC, which was given by Modigliani and Miller. So you have the traditional view of M&M. So under the traditional theory of cost of capital or WACC, the cost declines initially and then rises as gearing increases. Because when there's gearing debt, individual equity holders want to be compensated by higher hot return, and that will increase the graph back. The optimal capital structure will be at the point which WACC is lowest. And every financial manager, please take this from me, every financial manager is looking at the WACC which is going to be the lowest. Because when the WACC is lower, the NPV becomes higher, the market value becomes higher, the value of the share price becomes higher. Nobody wants a cost of a finance which is higher. If I'm going for fund and the fund is going to create a cost, a huge cost for me, what is the sense in it in going for that? So if I'm looking for a source of finance, I'm looking at the source of finance where its WACC is lower or lowest. The traditional view of capital structure is that there's an optimal capital structure and the company can increase its total value by suitable use of debt finance in its capital structure. The traditional view is as follows. As the level of gearing increases, very important, the cost of debt remains unchanged up to a certain level of gearing. Beyond this level, the cost of debt will increase. The cost of equity, as cost of debt increases, equity holders say we are assuming the highest form of risk. Why should it happen that you guys are increasing your return? Whilst I'm not increasing, so I also increase my return. So the cost of equity rises as the level of gearing increases and financial risk increases. There's a non-linear relationship between the cost of equity and gearing. The WACC does not remain constant, but rather falls initially as the proportion of debt capital increases and then begins to increase as the rising cost of equity and possibly of debt becomes more significant. The optimum level of gearing is where the company's WACC is minimized, or to say the lowest. So you can look at the conclusion over here. You look at some assumptions in here. This thing is going to be taken again. That is why I'm moving through like that. And this is the graph, right? This is the graph for the traditional theory. So you can see clearly that what happened is that there's going to be what? a stability of the cost of debt up to some point. At the stability, what happens? The WACC keeps falling and then tends to what? Rises. The WACC is rising on the basis that equity holders, since they take the highest form of risk, would now want to compensate themselves with an increase in return. So an increase in WACC will come mostly, will result mostly by an increase in what? Equity. An increase in cost of equity than an increase in cost of what? Debt. So that is the graph for you. You have Modigliani and Miller view. So Modigliani and Miller stated that in the absence of tax, so this Modigliani and Miller proposition without tax. Then we come to M&M with tax, right? So M&M stated that in the absence of tax, a company's capital structure would have no impact upon its WACC. M&M proposed that the total market value of a company in the absence of tax will be determined only by two factors. One, the total earnings of the company. Two, the level of operating or business risk attached to those earnings. The total market value would be computed by discounting the total earnings at the rate that is appropriate to the level of operating what risk. This rate would represent the WACC of the company. Very important. Then assumptions are in there. We need to be mindful. But I've treated both issues in the other recorded session, which I'll share with you. Financial ratios are computed like the earnings per share, dividend yield, interest cover, those bit, return on capital employed. I've showed you how to calculate those things. So you can just rush yourself through them and keep yourself okay. We have actually talked about these ratios. Now we come to beta. We have said that the beta calculates or measures the systematic risk. But unfortunately, we have types of betas. We have asset beta. Let me throw more light over here. If a company is financed by only equity, we say asset beta. Some students get themselves confused. So say asset beta, capital A, small a. They say that is what we call asset beta. We use asset beta when the company is financed solely by equity. And the asset beta of all firms in an industry are the same. The asset beta of all firms in an industry are the same. So what about equity beta? Some students think that when the company is financed by only equity, we say equity beta. Please, is wrong. It's not that. When it's only equity, we say asset beta. So when we say equity beta, this is used when the company is financed by both equity and debt. It's close. Be mindful of that. And irrespective of the type of beta, it measures the systematic risk of a company. In fact, in a normal context, a company cannot have a beta to be zero. A company having a beta of 0 is a dead company. It's a dead company. Now, this is how to calculate asset beta. We can calculate asset beta, BA, when we have equity beta. So it's equity beta times the value of equity over the value of equity plus the value of debt, 1 minus T. Then the asset beta, we can also calculate equity beta. Let me just put the formulas here to make life very simple since I'm wrapping up. So we say BE times, here we said the value of equity divided by the value of equity plus the value of debt, brackets 1 minus T. So this is the formula to calculate asset beta. What about equity beta? It is BE plus BA. And this time around, what happens is that the denominator here, you see, we are just into BA here was the starting point. BE was the second. What happens? Now the second becomes the first over here. And the first here becomes the second. And you know what happened? So the first becomes the second becomes what? The first. And at the same time, what we do over here is that when you go by this analysis, this time around, the denominator will become a numerator, and the numerator becomes the denominator. So over here, we say VE plus VD to bracket 1 minus T divided by VE divided by VE. So this is a way of calculating asset beta, which is only used if the company is financed by only equity. Then we have equity beta, which is used when the company is financed by both equity and debt. So please master the formulas and write them in your FM formula. The ways of calculating equity beta, the ways of calculating asset beta. If you have any question, please, you can unmute your speaker and come clear. But we talk about issues of gearing, de-gearing, and re-gearing and those bits later. But note that over here, this is 100%. 100%. Sorry. This will be 100% tested in December 2022 FM exams. So there are instances where since we have indicated that all firms in the industry is made up of firms, right? So if a firm is in the education industry, if we have UCC and Legon, since they are the same education industry, they assume the same asset beta. Just like some time back, that brutal fight, brutal beating, which happened at Midland Service and Loan, it affected all banks since they were in the same industry, right? So we say the asset beta of a firm in an industry is the same asset beta for all the firms in the industry. So if I want your equity beta, what happens? If I want an equity beta, right? Let's say that if I want asset beta, let me just say that if I want equity beta, please let me start again. Determining equity beta using let me just say determine equity beta from a proxy company equity beta. If I want an equity beta, my equity beta, from picking it from the equity beta of a similar company like me in our industry, what do? Forget about your equity beta here because it's not available. You are going to fish out, obtain your equity beta from your friend's beta. It is just like you are going to use the machine of your friend to generate your machine. That is it. So at the moment, you do not have your machine, which is the equity beta. You instead have your friend's machine, which is the beta over here. And I'm going to use your friend's machine to derive your machine. How do you do that? We have indicated that we use equity beta when the company is financed by equity and debt. So what you do is that all equity betas is made up of asset betas plus an element of debt. And we are saying that this asset beta is only used when the company is financed by equity. So all asset betas of all companies in the industry will be the same, but their equity betas will not be the same because the debt that company A can go for, company C cannot go for that. The debt that Unilever Ghana Limited can go for, Eddie's Pizza cannot go for that. So we need to be very careful. Though the asset betas, if we are in the same industry, sorry for using that example, but if we're in the same industry, our asset betas are going to be the same. UPSA and let's say Wisconsin, would they have the same asset beta? They will have the same asset beta because they are all in the education industry. But would their equity betas be the same? No, because what differentiates them is the debt. And the debt that UPSA can go for, Wisconsin cannot go for that. You can't go for that. The debt that UPSA can go for, UPI, Unique A+ Professional Institute, cannot go for that. We cannot go for that. If you come to my premises, Henry can go for that debt. If UPSA can go for particular debt from a particular bank, huge value, we cannot go for that. because we are not up to that what level. So if you have a particular company's equity beta, that means their beta, equity beta, is having the asset beta, which you also have the same, plus their debt. So what do? You go and take the debt portion out of it. Go and take the debt portion out of it. And since we are going to take the debt portion out of it, that is when we say the gearing. So you see, I want asset beta. So I'm going to take the debt portion from this equity beta for it to be left with what? The asset beta. So we say the gearing. And now that you take the debt portion out of equity beta, it will be left with asset beta. You now fix or input back the debt composition. And that is what we call what? Because at the moment, you took the debt out of the equity beta, it was left with asset beta. And you now need to add your debt composition. So it's just like take that out, add that back. So you are what? Re-gearing. So the first instance, we say the gearing. The gearing means you are taking that out. Then here, what do you say? We say what? Re-gearing, because you are bringing it back. That. You see it practical when I share with you the other recorded sessions. Then when you have asset beta correctly, use that to compute what? Your equity beta. Sorry, use to calculate your cost of equity. So let's look at the steps. Get an estimate of a systematic risk, which is the beta characteristics of the project operating cash flows by obtaining a published beta values from companies in the industry. That is the proxy company which have the same characteristics that you in the same industry. Adjust these betas to allow for the company's capital gearing level. That means you take the gearing, the debt component out. And when you take the debt component out, what will be left is the asset beta. That's why you say asset beta equals, right? Because that guy, equity beta, was having his debt. So take his debt out, it will be left with asset beta, which is the same as yours. Now that you have the asset beta BE, you now put back your debts. So this is how we put back our debts. So put back our debt to get the equity beta, and use the equity beta to calculate your cost of equity. You use to calculate your cost of equity, and thereafter use to calculate your WACC. So we have a notable example like that. So what we did over here is that they gave us the beta. They gave us the beta to be 1.59. And we don't need the beta of the proxy company. We need our beta. So what do? If we take their beta, we take debt out of it, it will be left with asset beta. Then when we have the asset beta, we now put the debt composition back using this time around our capital structure. Then we get the equity beta. They use the equity beta to come and calculate the cost of equity. Then after getting the cost of equity, use it to calculate the WACC of the company. Please, this is a very key question. I want you to solve it over and over again. Very examinable. Very examinable. The day of exam, December, we said it will be tested. So solve it over and over again. Here we give you the debts to equity composition. Equity ratio, average debt to equity is 1:2. So we have debt to be 1, equity is 3, and they are saying they are all at market value. So we calculate it based on that. Please, this example, go through over and over again. Weaknesses of the formula is described in there. You can talk about it. At this moment, if you have any question pertaining to this, please come clear. But this example, very, very key. Very, very key. Want me to throw more light on it again? I can do that. A company's debt, that is the equity ratio by market value, is 2:5. The corporate debt, which is assumed to be risk-free, yields 11% before tax. That is after taking consideration tax. The beta value of the company's equity is currently 1.1. The average returns on stock market equity is 16%. The company is now proposing to invest in a project which would involve diversification to a new industry, and the following information is available about this industry. Average beta coefficient of equity capital is 1.59. Average debt to equity is 1:2 market value. The rate of corporation tax is 30%. What would be a suitable cost of capital or the WACC to apply to the project? And we said, since we have the beta of the industry, we want the beta of the company or the project, not the industry. So if you have the industry beta, equity beta, we need to take the industry asset out. And taking the asset out, that means you're calculating, you're taking the debt out of the industry because the industry debt is in there. Taking their debt out, you calculate asset beta. And after getting asset beta, use the asset beta to calculate equity beta. Right? So watch that. Any question? Any question?
No, please.
You don't have any question? Hello? Okay, so if you don't have any question, please, I will advise you, this is a 38-page document. I would want you to go in and, back and forth, make your summary notes. For example, the questions in there, do not look at the solution. You can pick the notes, then you just go into the question and resolve it again yourself. This time around, you are not looking at the solution. And if you can solve them, then that means you have understood this. But sometimes, if you pick the question and the solution is next, you tend to deceive yourself that is simple. So do not do that. You can even rewrite the question somewhere in a different document or sheet of paper, put it down for 3 days, and after the 3rd day, come and try it and see if you can solve it. If you can solve it after the 3rd day or after 1 week time, then you understood it. So not just that we have the question in here, the solution in there, so you think that is fine, it is simple and it's not difficult. No. Pick the question out of this document. 1 week time or 2 weeks time, try and solve it. If you can solve it, resolve it, that means you have really understood what you have mastered. Right. So if there's none, then this is where I'll end the section. It's still your Twitter, Henry Breman. As you can still call me by 0243 583352. Our students can email me by bremanhenry1@gmail.com. You are doing a very good job. Continue. I will still share with you the recorded section pertaining to work to add up for you to learn more and more. Before we meet in the next section, ensure that you have gone through these recorded sessions. Have a very good evening and bye-bye to you.
Okay, thank you.
Don't mention it.